Let us consider the dangers of investing in a bubble and how to avoid them. How do we avoid investing? The danger associated with investing in a bubble. Number one is the risk of sudden price correction. There's that risk of sudden price correction. Investing in a bubble, exposes investors to the risk of a sharp price declines, when the bubble bursts. Of course, the bubble will not continue forever. It will surely burst. So the rapid inflation of asset prices driven by speculation and irrational optimism, often lead to a sudden market correction, resulting in a significant financial losses for those who bought during the peak. Those who bought at the peak, when the bubble eventually burst, it will lead to serious financial losses. And not only that, number two is overpaying for assets. Overpaying for assets during a bubble, you realize that stocks or other assets become overvalued. They are somewhat detached from, the price is somewhat detached from the underlying fundamental. And so when you invest, in this, when you invest at these inflated, price rates, you risk overpaying for an asset, limiting your potential future gains, exposing yourself to substantial losses when the price, adjusts. Of course, it will always adjust to a more reasonable or a more realistic level. Remember that you essentially make profits when you buy, not necessarily when you sell. And so when you buy at and artificially increased, unsustainable price, you may not really make enough profit, even if you make one. Number three is emotional decision making and panic selling. Emotional decision making and panic selling. So there's this particular, FOMO, fear of missing out, which often drive investors to buy into a bubble. And when the market corrects, panic selling can set in. It could lead to declining prices, which will compound investors' losses. So emotional decision, when you make decision based on emotions, such as chasing rising prices without considering the risk, increases the likelihood of buying at the peak. You may end up buying at the peak and then selling during a panic, at the bottom. So you end up losing money. You buy at the peak and you sell at the bottom. You buy high and sell low. That's a classic example of investor behavior at this juncture. When people buy without considering fundamentals, that's the result at the end of the day. Number four is increased volatility. Is that increased volatility? So assets in a bubble are prone to extreme volatility. The rapid rise in prices followed by a sudden collapse can result in an unpredictable price swing, making it difficult for investors to time their buying and selling decisions effectively. And so this volatility can erode wealth, especially for those who are not prepared for such drastic fluctuations. The stock market is a place where billions are made and lost every day. What an irony. Billions of dollars or whichever currency is lost and made on a daily basis, depending on which side of the trade you find yourself, depending on when you buy and when you sell. Number five is The long-term recovery challenge. The long-term recovery challenge. Once a bubble bursts, it can take years. It can take years for the market to recover fully to its previous level. So in some cases, certain assets or sectors may never fully recover, leaving investors who entered during the bubble or who buy at the peak to get stuck with significant losses or underperforming investments. And so, avoid? Uh, how do we avoid a bubble? How do we avoid, you know, a bubble? How do we avoid investing in a bubble? Number one is focus on fundamentals. You prioritize investment based on solid fundamentals such as earnings, cash flow, and other relevant valuation metrics like earning per share, price to book, and yield. And it's very important actually. So avoid buying assets solely by hype or rising prices. Don't follow the heart. Don't be swayed by heart mentality or by noise in the market. And ensure that you understand the true value of your investments. Sit down, analytically. You analyze the company you are buying into. All right. If you don't know how to analyze the company, this is why this particular channel is for you. I have videos on how to analyze and carry out fundamental analysis of stocks, of assets you want to invest in. So buy based on the result of your analysis, not based on the prevailing hype or enthusiasm or speculation or euphoria in the market. Those ones are often don't really correlate with fundamentals. Number two is watch out for overvaluation. Watch out for overvaluation. So use key metrics, like PE ratios, like price to book, like dividend yield to assess whether an asset is overvalued or not. This selling at or below its intrinsic value, you ask yourself that relevant question. As if prices are rising without corresponding improvement in earnings or profit or other financial metrics, it could indicate the formation of a bubble. Number four is keep emotion out of investing. Keep emotion out of investing. Be as solid, as emotionless as a statue. Don't be swayed by the winds of emotion. Lock emotion outside the door when it comes to investing. And so use, key valuation ratios to help you, use these fundamentals, and don't allow your emotion to determine what you buy, and also avoid hard mentality. So avoid, don't allow emotion to determine what you do. Emotional decision making should not come into play. It leads to poor investment choices, especially when driven by short-term market movements or the fear of missing out. So keep emotions out. Be governed essentially by fundamentals. Use the relevant valuation ratios, the relevant metrics to guide your buy or sell behavior. Number five is that set clear investment goals and limits. Don't just invest haphazardly. You must have a goal. What do I want to achieve? What is my time horizon? What level of risk will I be able to tolerate? You determine your risk horizon. Then you need to establish a clear financial goals, a risk tolerance before investing, and stick to them. Make sure you are disciplined enough to be able to stick to your set out objectives. This discipline will help you avoid impulsive impulsive investment decisions during speculative excesses. So additionally, consider a stop loss order. You could place a stop loss order to automatically sell investment if it falls below a certain threshold, a certain price limit. This will help you to mitigate potential losses during a downturn. So you set a stop loss. A stop loss will help you to, it will automatically sell off your shares at the price you indicated. Please like this video and subscribe to this channel. Don't forget to drop a comment in the comment section. It will then help me a lot. Number 6 is monitor market sentiments. Monitor market sentiments. So you need to stay informed about market trends and sentiments. Paying attention to signs of irrational exuberance or speculative behavior. I told us earlier that unfortunately the market could be driven by sentiment rather than reason or logic. If the market is overly optimistic, or is dominated by hype, it might be the sign of a bubble, and you should take necessary precautions. Number 7 is invest for the long term. Invest for the long term. So you focus on long term rather than short term gains. Investing is in high quality companies with strong fundamentals tend to be less susceptible to a kind of bubble driven to a bubble driven volatility in the markets. And it's also more likely to recover faster than its peers in the same sector. So that is it. This is how to avoid avoid the dangers of investing in the market bubble.